So I thought what we would do is try to break this down a little bit. I mean, obviously there's a lot of things we can talk about, and this panel could go on all day, but break it down a little bit into some macro issues. Those are big issues external to our industry that are having a profound effect on our industry. We'll talk a little bit about venture firms and venture funds and some of the changes going on in those entities and how they affect the medical device investing climate. And then finally, portfolio company activities and what we're seeing in our portfolio companies as a response to what's going on and how things are changing going forward. So starting on kind of a macro level, we'll leave the economy to the bankers. But looking at some of these outside forces, I think probably first and foremost is the Food and Drug Administration and how a shift to the right and an increasingly conservative stance there is impacting every aspect of what we do. And I think one of the concerns that I think we all have is, what impact is that having on innovation? Is it stifling innovation? Is it moving innovation offshore? Glenn got into a little of that last night. And I think what I'd like to do is talk to some of our panelists here and get their perspectives on how the FDA's shift to the right, my term, is impacting what they do. And I'll start with Pete. One of the questions here that has been bandied about is a flight to later stage, that VCs are no longer interested in taking on regulatory risk. It's too unpredictable and too long. Pete, is that something that you've adjusted your thinking as you look at opportunities, and how so?
The regulatory process in the companies that we invest in, all of us invest in, I think now is as uncertain as I've ever seen it. It's no secret that when we sit down to make investment decisions, we have to have some sort of way of anticipating what the requirements are and how long it might take to meet those requirements. And today, both at the PMA level and at the 510K level, it's not clear. Not only is it not clear what the requirements are, which I think would be true in the 510K area, but it's also not clear that they'd be administered in a consistent way. So it has become a major issue. I think there are reasons for it that we've come to understand. I think the FDA and specifically CDRH is undergoing an exhaustive internal examination of how they operate and what their rules ought to be. And I think there's probably legitimate reasons for doing that. But the result, at least from my perspective, is that it's very difficult for us, both with existing companies and new companies, to understand what the requirements in the future might be. And it plays a big role in what we're willing to invest in and not invest in.
So Mike, is this turning you away from earlier stage opportunities or shifting you away from sort of the PMA big new idea opportunities?
So, it actually hasn't, but it's definitely causing us to rethink the filter. So I think Pete said the key word, which is predictability. And the struggle right now is we've lost predictability in the regulatory process. And in many ways, I think that's more true for 510K than PMA. The 510K process, for all practical purposes, is drifting towards a PMA-like process. What concerns me around PMA is panel and the unpredictability of panels. So we just did a Series A deal. It hasn't been announced yet, but it is a PMA. And what we're trying to do with our filters is really look at things that are very large markets that in many ways can absorb or justify the longer timelines and the longer experience. And then from a regulatory path, this is an established market. So in theory, there is a known path that others have gone through ahead of us, and that can always change, as we've seen in the stent market and in other places. But at least in terms of trying to stack up predictability, we think it's as good a bet as we can make right now for something that we're going to do early stage. We'll see if that proves to be right.
Thanks. John, for the entrepreneur who's got, the napkin idea, the new way of looking at a problem, fundamentally different way of addressing an unmet clinical need where there are no precedents or predicates, and it's a potentially large market, but only a potentially large market. Any advice for how they should go about trying to finance those opportunities where the regulatory risk is clearly significant, but beyond that, largely unpredictable, as Mike described.
Yeah. Well, first of all, we always go by what the clinical benefit of the product is, and if it's significant enough, we get interested. Significant enough clinically for a significant enough market. And then we always try to think through what's the probability of it actually being successful at, being engineered if it's a device and getting through clinical trials. And that hasn't really changed. So if it's a big enough opportunity, we would definitely still do it. I think I agree with the comments before that the 510K process is gradually becoming 510K with clinicals, and there's not very much difference between that and a PMA when you get down to it. And we're all waiting for new 510K rules, but undoubtedly they're going to be even more toward PMA-like things than they are today. So I think I haven't quite answered your question yet, and I'm going to try to get to it, but I think that's how we look at it. In terms of early stage stuff, there are still firms that I think the venture market is bifurcated. A lot of people are trying to find later stage opportunities, and certainly that's one of the things we're doing. We have invested in our current fund 3 companies that had products that were already FDA approved when we did the investment, and that felt like a good opportunity. But we would still do an early stage one if something really, really compelling came along. I think there is a bifurcation in the venture market. There are people who don't want to touch anything early right now, and there are people who historically have done a lot of early stage stuff, and they think even more that that's what they're continuing to do. So I think you just have to hunt out the firms that are still doing early stage stuff if you're an entrepreneur trying to get funded on something that's a napkin idea in your terminology. And you just got to be patient and find the firms that are interested in that stage.
So white spaces aren't off the table, but again, we all kind of become creatures of our own past successes or failures. And I think we've all had now situations at FDA and then panel where we've gotten into these white space areas, and then where we got hung up is that there really wasn't a clear definition around what is the clinical endpoint, what is the clinical benefit, what is the target that you're trying to hit. So one of the things that we're now looking at is we still like white spaces, but if there's ambiguity around what is clinically relevant or significant, that gives us pause, because we know that you're going to get into a panel discussion where FDA may have one point of view, the clinicians on the panel may have another point of view, your advisors may have yet another point of view, and you really could end up getting in somebody's crosshairs and not know it until the whole end of the process.
So the dilemma here is that certainly you need a product that adds value with an unmet need. You need that. And it used to be that if you did that at a cost that was no greater than the alternative, you had a product. That's just not true today. You need to both add value and reduce cost, because the buyer is changing. It used to be you could focus on the thought-leading clinician, and these thought-leading clinicians are now increasingly becoming part of more integrated systems. So it's sort of committees making decisions based on the cost effectiveness over the institution, as opposed to a thought leader trying a few products. And that's a higher hurdle, and one that I think causes us to be a little bit more careful about what products we'd back at an early stage.
So moving on to healthcare reform, kind of hard to exactly know what that encompasses, but clearly has had a series of impacts here. Probably the most concerning at some levels is this idea of a comparative effectiveness and what that really means. It kind of gets to what you're talking about, Pete. And we've seen the columnist article on vertebroplasty in New England Journal. A lot of structural issues with that and a lot of controversy in the clinical community, but has success, that one article has now caused a number of Medicare intermediaries to start questioning whether they'll pay for vertebroplasty and kyphoplasty despite more than a decade of quite effective clinical use, and I think an outcry from the clinical community. And that's just the tip of the iceberg. So, I think as we look at opportunities going forward, we have to include the cost element and this element of cost effectiveness. Kind of brings me to this idea of frugal innovation that we hear a lot about, which is rather than being better and more expensive, You can go to just as good and cheaper, and then there's this idea of what about a little bit less good but a whole lot less expensive? And does that have a role going forward? Certainly no one's ever brought a deal like that to our attention.
I think long-term, there's no question that the system is going to be underfunded, and therefore innovation is going to be more difficult to sell. But I think in the short term, what's going to benefit are products that benefit from increased utilization. I think there will be higher utilization, and it's not typically the kind of products we invest in. But if there are opportunities where there are approved products that would benefit from a larger growing market from a utilization standpoint, I think those are good places to look right now.
Yeah, and I think you mentioned the frugal innovation, but again, I think the challenge is, again, who is it cheaper to? So it may be cheaper to the hospital, but at the same time, we've seen other areas where if the doctor gets less reimbursement, that could actually prove to be a negative in adoption. So it's, again, trying to work through all the constituents and find out, yes, and we see this with a lot of minimally invasive therapies, where at times you'll get pushback from the societies because they're worried about the more invasive surgeries coming under re-review and getting re-rucked for reimbursement. So how you navigate those waters and where the impediments are to adoption, it is cheaper, but that doesn't necessarily mean it's going to even make its way through the system in this new environment, because there are going to be barriers along the way, and those are tricky to overcome.
Clearly, the fundraising environment for venture groups has become much more challenging since the economic downturn. Most of the traditional limited partners are still working their way through various liquidity challenges. Venture returns, quite frankly, have been somewhat lackluster over the past decade. Not that the public markets have been a lot better, but the bubble returns of the late 90s are now washing out of the rolling 10-year numbers, and I think that's a challenge. So firms that are raising funds are raising smaller funds. Personnel are shrinking, and I think the overall industry is going to consolidate, and that'll continue for some time. Wanted to get the opinion of the panel on what our industry might look like 5 years from now.
Well, I was meeting with an LP last week, and it was funny. She said, Mike, I'm tired of these healthcare funds that are only giving us 2x returns. And I kind of paused and looked at it. So are you really getting 2x returns right now? I think that's not so bad across the industry if you look at the 10-year look back. But it kind of gives you a sense for the mindset of the LPs, which is, to us, we're just another asset class. And so they compare venture to distressed funds to other sorts of assets and see how we stack up. And the net result of all of that is they're starting to question the risk return kind of profile, and they're pulling back clearly in terms of how much dollars they're investing. So that's going to have a clear impact on the industry. It already is. I think the number I've heard is that our industry's already shrunk 25% in the last 12 months. I don't know if that's true or not, but that's the number that's thrown around. And I think the reality is going to be, all funds are going to be smaller, and then beyond that, maybe 50% of the funds are going to go away. And that's the kind of numbers that are bandied about. I don't know that that's necessarily a bad thing. There is clearly spaces that are overheated. You don't need, we're on the obesity breakout session. There's 35 companies all kind of pursuing a big area. There's going to be multiple winners, but do you need 35 companies? And so there's a part of that that's going to be healthy, but it's certainly going to contract, and it could contract dramatically.
People got to remember that the whole universe of investing is down 25% or so in the last 2 years. So if you look at any big mutual fund company, if they were managing $1 trillion 2 years ago, they're managing $750 billion today. The hedge funds are generally down, partly because their returns are down, and partly because they've had redemptions. So it's not just the venture business; it's the whole investment universe. We had our LP meeting a couple of weeks ago, and we put up our returns for the last decade, the benchmark from Cambridge Associates, which kind of keeps tabs on a lot of different venture funds and aggregates them. And we also put up the S&P 500 because I wanted to remind people that the S&P 500 has been down for the last 10 years, and the Cambridge Associates numbers were a little bit better than they were, and we were a little bit better than that. So, and I got a lot of nodding heads in the room when I said I put the S&P 500 up here to remind everybody that as much as you think venture capital has underperformed in the last 10 years, and I hate to be the tallest pygmy in the room, but the S&P 500 and all the broad averages have been horrible for the last 10 years, and everybody kind of acknowledges that. So I think the smart LPs looking forward are asking themselves, kind of what's happening going forward, and that's really what it's all about. And I think they will pick good venture funds, and they'll still believe in innovation, and that's what's essentially going to put a floor under the industry. I don't know whether it's going to be a shrinkage of half or a third. I don't think it really will be a half, though.
If you think back 5 years, I mean, we had this situation where all this money obviously went into technology. There was the big bust. And in the time period, sort of 2003, 2004, 2005, in my opinion, a lot of money went into healthcare venture capital, somewhat as a reaction to these investors being overinvested in technology and being burned. So given that, I think there's been too much of a supply of capital for too few good deals in the life science, medical technology area. And I think that's one of the reasons. I think there's a lot of reasons. That's one of the reasons returns are under pressure right now. So I think there will be a bit of a shakeout. I don't think the industry is going to go away, but there will be a little bit of a shakeout as attentive, smart, limited partners look for the funds that really can find the right investments and which can't.
I do believe now is a good time to be doing early stage investing because there are fewer companies getting financed right now. And I think as you project forward 5, 6, 7, 8 years, as we start to think about these companies either going public or M&A processes, there's just going to be fewer things to look at and to choose from. And that scarcity value, in my mind, is a good thing. It actually will make those companies inherently more valuable as long as they're still meeting all the fundamentals of hitting an unmet need, a big market, et cetera, et cetera. So I think it can be healthy. I don't think it's going to go away. I think it will contract, and it is contracting. But the pendulum on these things swing, and if things start to get robust, then we'll see the money come back.
So, I mean, one of the things going on right now is some syndicates have plenty of reserves, in aggregate to keep funding companies for a while, and some don't. Or in some of the venture people have strong reserves and some don't. And that dynamic is really important. If you're doing an early stage company, you've got a really strong syndicate and can keep funding it for a while, then you're, I think, much more likely to do well with the investment. And as an entrepreneur, you're much more likely to have what you want in terms of the venture capitalists behind you. So I think it's very important to pay attention to that.
Clearly, syndicate risk has become a big issue. Who's got deep pockets and who doesn't? I think it's resulted in some reallocation of ownership among syndicate partners as various firms run out of money. I think the other issue that's related is financing risk has become a big issue. And what we're seeing are larger tranche deals as opposed to Series A, B, and C, and each being done independently. I think groups are looking at each other and saying that, we're going to raise money now. It's not clear what the ambient environment's going to be in 2 years when we want to raise our next round. Let's bake it in now and predetermine a much larger financing that may have tranches and may have milestones and may even have step-ups. But let's pre-bake that and build our syndicate to avoid some of these issues. And we're seeing that more and more consistently. It's not great for the founders because typically you don't see these milestone-based inflection points in value the way historically you have, but I think it's a reaction to the fact that you just don't know where the cash is going to come from. And I think cash is king.
For those of you who are founders out there, I think you have to keep in mind that it's sort of an alluring notion that you can do the first round with less dilution, and then when you hit milestones, you'll go out and raise more money. But it's these events, I think, as Bill and John were pointing out, it's these sort of external financing events which really clobber the founders, right? Because you have new people coming in with different terms, and there's this sort sort of dance that goes on. So if you can get a syndicate early on that has the staying power, it may seem like a lot of dilution, but in the long run, I would argue it's less dilution because you have less of a need to go bring new folks into the company.
Yeah, I've seen it play out both ways. I think, to the extent you've got these very large tranched financings coming in at low or down valuations relative to prior financings, the dilution is pretty substantial, and there's no way out for a founder. Investors can always continue to buy ownership and maintain or increase ownership if they'd like, but we've seen some founders get kind of squeezed in that financing environment.
If you're a founder that's not in, operating management on a, continuing basis, then yeah, you do get crushed. Otherwise, if you are in operating management, generally the management team gets more or less protected from the major dilution. If you look, going back over 20 years, at any company that's raised a lot of money, the management team owns 15% of the common equivalents, as kind of a rule of thumb in any company that's sort of gotten to the late stage. And that, if it's had a few down rounds, that's true. If it's had up rounds, that's true. So it's the founder who had 10% of the company at the end of the Series A financing, and maybe it was a professor somewhere who came up with the idea that gets hurt badly in those, but not necessarily, the operating people.
There's been this focus on opportunity outside the United States, to try to avoid the FDA, avoid some of the reimbursement risks and challenges that we have here. There's a notion of China as an exciting developing market. Maybe the same's true in India. You've got innovation occurring in Israel. There's a lot of things going on outside the U.S. Core valve, I don't know how many companies have come and pitched the core valve model of selling in Europe. Are you guys looking at OUS opportunities more proactively than maybe you had in the past? Are you seeing more opportunities that have their nexus outside the U.S.?
We are not spending a lot of time looking for those. I have a hard enough time keeping track of what's in my backyard. So, for me to do a deal in China, it may be a great opportunity, but it's just not, particularly for early stage investing, that's very hard to do. So, and I've gotten my butt handed to me whenever I've ventured beyond my, area of domain. So my partners remind me of that. So, I'm going to stay local. That's not to say there aren't those opportunities, but we're not looking for them or seeing them.
John, you guys looking outside the U.S.?
Not in that sense. In terms of companies domiciled outside the U.S., our attitude is, we don't know the headhunters outside the U.S. to find new management or to enhance the management team. We don't really, we don't know the people who lease space. All the sort of tricks that as a venture capital firm or that the industry sort of has to help out companies, we don't have outside the United States. So in terms of companies domiciled out there, it's just not our sweet spot, I think, as Mike was saying. In terms of clinical trials, I think almost any company is doing, device or biotech is doing as much outside the US as they can. The regulatory environment to get your clinical trial done is definitely easier, and you still have to do a fair amount of clinicals inside the US to get FDA approval, but everybody is doing stuff outside the US. A lot of engineering and certainly over in the biotech side, things like medicinal chemistry is being done outside the US on a contract basis. So it's not that our companies aren't doing things outside the US, but they're not domiciled there. And then the other thing I'll add is, despite the core valve thing, reimbursement in the US is still way higher, and the total size of the US market is way higher than it is, say, in Europe. And that's doubly true for China and India. So I think the mother lode is still the United States.
On this point that Bill just made, I think there is a swing in that direction, but I don't think it's, I think the value of commercializing outside the US, and I think there's real value to that, increasing value to that because of the difficulty inside, I don't think you can make any money doing that, okay? I think you can try, but lower reimbursement and higher marketing costs, after all, there's different countries with different channels, really prevents you from making much money. But it does sort of establish the clinical credibility of the product. And I think that's quite valuable to a strategic buyer. So I think that the strategy of sort of gearing up the commercialization effort and getting the product in the market and establishing that traction has real value. But I don't know that anyone's making a lot of profit.
Yeah, we've not invested in any of those models either. I think what it reflects, though, is a exasperation and frustration on the part of the entrepreneur community with the unpredictability of FDA and, quite frankly, the unwillingness of a lot of venture firms to invest in early stage, big idea companies domestically. But at least to my knowledge, no one's really demonstrated that model. They all port to CoreValve. There are a lot of very specific issues unique to CoreValve that I don't think are necessarily broadly replicable.
As dour as I am about the trends in FDA, and I'm about as dour as anyone, I think we've got a couple more years of the FDA getting worse and worse, but I'm beginning to sense a real backlash. And the backlash from industry is essentially irrelevant because Congress and the newspapers think industry is bad. But the smell I'm having is there are a lot of senior academics who are beginning to be upset at the FDA as well. I was talking to the dean of a leading medical school, very prestigious medical school, a couple days ago, who was talking about this and talking about, in his words, staking his deanship on trying to get something to happen about that, because in his mind, the things that were being invented at the medical school increasingly weren't making it to the patient bedside, and he thought FDA was part of the reason. So when people who use that kind of bully pulpit, if they do, to take on FDA, that will get newspapers and the Congress to pay attention in a totally different way than industry. And I think that's beginning to be an undercurrent under there. I don't think it's going to be public for a while, but I think eventually it will be, and that will turn it around a little bit.
To the extent Congress starts to hear from its constituents, whether they're academics or industry or patient advocacy groups.
I think that's another big one.
I think all of this is maybe there is a groundswell kind of reaction to what's happening.
I mean, these things are, to me, are always a pendulum, and it goes one way too far, and then people start to figure out, oops, the patients aren't getting the devices, they're not getting the treatments, they're not getting access, and I think over time, I don't know if that over time is 2 years, 3 years, or 8 years, but I think you will start to see it move back, hopefully, towards the middle.
With that, I think we'll close. Thank you for your attention.